Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that is pretty popular in the stock market, one of the bigger companies that are trading, and that stock is ExxonMobil. And this company recently announced earnings for the first quarter of 2023. You can see they're up 6% while the rest of the market is up 3%. So they're doing pretty good, pretty much keeping on par with the rest of the market. And so I'm going to look at some of the recent news that came out surrounding Exxon. I'm going to look at their financial statements to get a better understanding of the financial health of the company. And then I'm going to use the discounted cash flow model to figure out the intrinsic value per share for Exxon so we could know if this is a good price to buy into the stock from a value investing perspective. So first off, the article right here is titled "Up 20% in 12 Months. Is ExxonMobil really a buy?" And they point out right here that the energy giant is outperforming some of its closest peers. And with energy prices falling, ExxonMobil is most appropriate for just a small group of investors, but maybe not for everybody. So in the first paragraph here, they point out something important to note about the energy sector, which is that it's highly cyclical and it isn't immune to the normal ups and downs of energy prices. So if energy prices are going up, energy stocks will be going up. If they're going down, energy stocks will be going down. That's pretty much universal across all energy companies like ExxonMobil, ConocoPhillips, Chevron, or whichever other company you're looking at. Over the last 4 decades, though, ExxonMobil has impressively increased their dividend, even though the energy industry is highly cyclical. They have a rock-solid balance sheet with very low leverage. They have a debt-to-equity ratio that's as tiny as 0.2 times, and that makes it so that it's pretty easy in the future for Exxon to take on debt in order to continue to support their dividend if they need to, because they are not leveraged and they have a very solid balance sheet at the moment. But the main reason why their stock has been fluctuating a bit in the past is because, or in the recent past, is because the global pandemic obviously led to economic shutdowns, and that reduced the demand for oil, and as a result, Exxon's stock plummeted. But then as the economy began to open up again, inflation happened and oil prices recovered and increased a lot. And so energy companies like Exxon ended up being really profitable, but right now something else is shifting. One of their competitors, Chevron, another US-based energy giant, also has a strong balance sheet, but their stock is down 6%. Whereas ExxonMobil stock is up. So this could suggest that investors are maybe a little bit too excited about the prospects for Exxon, given how similar they are to Chevron. Right here, they point out that when oil prices went higher, Exxon's revenue and earnings went higher. Now that oil prices are declining, Exxon's revenue and earnings are also declining. And so it's potentially possible that although Exxon has had a really good run, they haven't figured out a way to avoid the inherent cyclical nature of the energy sector. And so there might be other options that are more attractive for investors like Chevron, which potentially has already priced in some of the bad news, whereas ExxonMobil has not. And so to end off the article, for dividend investors who are looking for an energy stock to buy into that is highly diversified, ExxonMobil might be a good starting point, but it's important to note that at the moment it might be priced at a premium relative to its peers, given how similar the company is to its competitors, but its competitors' stock prices are basically declining slightly, whereas ExxonMobil's is continuing to increase. And so right here in this quarterly reports, I'm going to look at their income statement, balance sheet, and their cash flow statement. To start off, this is their income statement. We can see that revenue year over year declined from $90 billion to $86 billion. But that being said, net income increased from $5.4 billion to $11.4 billion. So that's an increase of over 100% for their bottom line net income, despite the fact that their revenues declined year over year. And right here, this is their balance sheet. We can see that total assets increased very slightly, but pretty much stayed the same at $369 billion. Most of their business is financed by equity. They have $206 billion worth of total equity, and they also have $440 billion of retained earnings here on their balance sheet. And lastly, our cash flow statement, we can see operating cash flow increased year over year from 14 billion to 16 billion. And we can see they paid out dividends to shareholders of $3.7 billion. And they also acquired common stock of 4.3 billion, up from 2 billion in the first quarter of 2022 last year. So they're prioritizing returning value back to shareholders more this quarter than they were last year. So that's definitely a good sign for shareholders who have not only experienced the price increase, but they've also been experiencing the increasing dividend. So this is a discounted cash flow model to figure out the intrinsic value per share for Exxon. Yahoo Finance is estimating that the company is going to decline. They have a declining growth rate of 10% for the next 5 years. So I use that for this model. Obviously, I advise everyone watching this video to do your own due diligence and come up with your own metrics if you're going to try to value a company. And then right here for free cash flow for their most recent full year, they had $58 billion of free cash flow, $8 billion of debt on their balance sheet, and 4 billion shares outstanding, putting their intrinsic value per share at $89 per share. That means that at the moment they're currently trading above their estimated intrinsic value at $105 per share. So based on these estimates from Yahoo Finance, they would not be presenting a buying opportunity from a value investing perspective at the moment. Then on the right hand side here, I compare them to two of their competitors, Chevron and ConocoPhillips. We can see that across the board, it looks like ConocoPhillips has the best profit margins. ExxonMobil has the lowest PE ratio, but they also have the highest dividend yield at 3.22% compared to ConocoPhillips' only 1.6%. So for every $100 you invest into ExxonMobil, you're going to get paid $3.22 per year, or at least that's what it was last year. And for ConocoPhillips, it would only be $1.60 for every $100 you invested into ConocoPhillips. So from a competitor analysis perspective for their industry, the energy industry, looks like you'd probably want to give it to ExxonMobil in terms of PE ratio because they have the lowest one, and then also for their dividend payout. But in terms of profit margins, it looks like it would go to ConocoPhillips. And then to end off the video, I wanted to compare them to some other companies we've looked at in the past. In terms of share price compared to intrinsic value, it looks like ExxonMobil is currently trading slightly above their intrinsic value per share. They are trading at 1.2 times their intrinsic value of $89 per share. Right now, Google, GE, Chevron, and ConocoPhillips are the only 4 companies that are trading below intrinsic value per share, as we can see right here. But ExxonMobil does make it onto 5th place for this table. In terms of growth rate, we saw that ExxonMobil is currently projected to have a negative 10% growth rate for the next 5 years. They were previously at the top of our table with a 26.6% estimated growth rate, but Yahoo Finance adjusted their estimates to negative 10%, so that now moves them down to the 10th place spot on our table. In terms of profitability, we can see ExxonMobil has a 25% gross profit margin and a 13% net profit margin. That is not good enough to get them onto either table here. Adobe holds the number 1 spot at 89% for gross profit, and Microsoft holds the number 1 spot at 36% for net profit. And then lastly, for stock performance, we can see that over the last 5 years, ExxonMobil has returned 28%, not including their dividend payout, and that is not good enough to get them onto the table here. Tesla holds the number 1 spot at about 1,000% over the last 5 years. So in terms of comparing them to the other companies we've looked at, it looks like they're not very competitive in terms of profitability and stock performance or growth rate. But in terms of their intrinsic value per share compared to their share price, it looks like they're doing pretty good. They're currently not trading below intrinsic value, but they do make it onto the 5th place spot for the top 10 companies we've looked at over the last 20 to 30 videos. Comparing them to the other companies in their industry, if it was down to profit margins, you'd probably want to give it to ConocoPhillips, but ExxonMobil does have the highest dividend yield compared to their competitors. And then lastly, as I touched on, in terms of their intrinsic value per share, the discounted cash flow model proved that they were currently not trading below their intrinsic value per share. So I'd love to know what you guys think of ExxonMobil. Is it a buy at the current share price? Let me know your thoughts in the comment section down below. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.